Picture the exact moment the world's financial order quietly cracks and almost nobody notices at first. No sirens, no breaking news chyrons screaming the end of an empire. Just a small paragraph buried in a financial report that says the United States dollar has slipped to its lowest share of global reserves in more than a century. That is how empires actually end, not with a bang, but with a data point nobody reads twice. Meet Elena Ruiz, 41 years old, owner of a mid-sized furniture import business just outside Charlotte, North Carolina. She built the company from a single rented warehouse into an operation that brings in teak dining sets from Vietnam, upholstered sofas from Mexico, and steel frame components from Turkey. She has never once in her adult life thought about what a reserve currency actually is. She thinks about container shipping rates, about tariffs, about whether her biggest client will renew their contract. Then one afternoon, her accountant sends her a text that simply says, "Did you see this?" with a link attached. The headline reads that the International Monetary Fund's latest currency composition data shows the dollar's share of global foreign exchange reserves has fallen below 57%, down from over 71% at the turn of the millennium, the lowest level recorded in nearly 30 years of tracking. Elena shrugs it off at first. Numbers on a screen. Nothing changes overnight, and honestly, nothing does change overnight. That is the part almost nobody tells you about currency shifts. They are not explosions. They are erosions, and erosions are far more dangerous precisely because they are so easy to ignore. For 80 years, the dollar has been the backbone of nearly everything in global commerce. Oil has been priced in it since the 1970s. Central banks around the world hold it as their primary store of value. Governments borrow in it because investors everywhere trust it more than their own currencies. Companies invoice international trades in it even when neither party is American. This arrangement, sometimes called an exorbitant privilege, has let the United States borrow enormous sums at lower interest rates than almost any other nation on earth, run deficits that would sink other economies, and use its financial system as a tool of geopolitical leverage through sanctions that can freeze a hostile government out of global trade in an instant. But privileges built on trust can erode when trust erodes, and trust has been eroding for years now, quietly, unevenly, but unmistakably. Elena starts reading more. She learns that this is not some fringe conspiracy theory circulating on obscure financial blogs. It is showing up in official data from the International Monetary Fund's Currency Composition of Official Foreign Exchange Reserves report, the same dataset economists have used for decades to track exactly this kind of shift. She learns that more than 30 nations are now actively working to reduce their dependence on the dollar in trade settlements, that the effort has a name now, de-dollarization, a term that used to sound like something only academics cared about and now shows up in mainstream financial headlines on a near-weekly basis. She learns about the freezing of roughly $300 billion in Russian central bank reserves after the invasion of Ukraine in 2022, an event that quietly terrified finance ministries in dozens of countries that had nothing to do with that war. If dollar reserves can be frozen for one nation over one conflict, any nation with a disagreement with Washington has to ask itself whether its own reserves are truly safe, or whether they are simply parked at the pleasure of another government. That single realization did more to accelerate the search for alternatives than a decade of speeches about monetary sovereignty ever could. Elena keeps reading and finds herself falling down a rabbit hole that connects gold vaults, oil tankers, digital currencies, and treasury bond auctions into one enormous interlocking story. She learns that central banks bought gold at a pace in the past few years that would have sounded absurd a decade earlier, with annual purchases running close to 850 tons, nearly double the historical average recorded between 2010 and 2021. Poland has been one of the most aggressive buyers, adding well over 100 tons in a single recent year as it builds toward a longer-term target of 700 tons, driven largely by anxiety over its exposed position on NATO's eastern frontier. China has been buying too, month after month, for nearly 2 years straight, and many analysts believe its actual holdings are considerably larger than what gets officially reported, with additional gold quietly routed through state banks and sovereign wealth vehicles that never show up in the headline statistics. A recent survey of dozens of central banks around the world found that the overwhelming majority expect global gold holdings to keep climbing over the next year, and a record share expect their own institutions to be among the buyers. Gold cannot be frozen by an executive order. It cannot be sanctioned. It does not depend on the political mood in Washington. That single property, its neutrality, has turned it from a relic asset into the most trusted reserve instrument on the planet again, with some analysts now noting it has actually overtaken United States Treasury securities as the largest reserve asset held by the world's central banks combined. Elena thinks about her own savings, mostly in a retirement account tied to the stock market, and wonders for the first time whether she should be thinking about this too. But the story does not stop at gold. Elena discovers the acronym BRICS everywhere she looks now, the loose economic bloc of Brazil, Russia, India, China, and South Africa, which has expanded to include new members like Iran, Egypt, the United Arab Emirates, Ethiopia, and Indonesia. For years, there has been talk of a unified BRICS currency that would directly challenge the dollar, and Elena assumed, like most people, that this must already be well underway. What she finds instead is more nuanced. A single shared currency has not launched, and according to most serious analysts, is not close to launching, because the requirements for something to function as a genuine reserve currency are brutally demanding. It needs deep, liquid, and open financial markets. It needs a credible and independent central bank. It needs full convertibility with minimal capital controls. It needs the rule of law and institutional trust built up over decades, not years. India, one of the bloc's most influential members, has openly declined to support the idea of a common BRICS currency, insisting that its own rupee remains sovereign and independent. What the bloc has built instead is something more practical and, in some ways, more threatening to the old system precisely because it is less flashy. A payment infrastructure project, sometimes called BRICS Pay, that links national payment systems directly to each other, letting a country like India settle a trade with Russia in rupees or rubles without ever converting through dollars or routing through Western clearinghouses. There's also something called the BRICS Unit, a settlement instrument unveiled through a pilot program, backed partly by gold and partly by a basket of member currencies, drawing on the bloc's combined gold reserves of well over 6,000 tons. None of this replaces the dollar. Analysts are almost unanimous on that point. What it does is give nations an exit ramp, an alternative route around the dollar-based system for specific transactions. And every time that exit ramp gets used, a small sliver of demand for dollars disappears. It is death by 1,000 small transactions rather than one dramatic collapse. Helena starts to understand why this matters for a furniture importer in North Carolina. Then she stumbles onto the oil story, and this is the part that genuinely unsettles her, because oil has always felt like the dollar's deepest anchor. Back in the mid-1970s, the United States struck an arrangement with Saudi Arabia, sometimes called the petrodollar system, in which Saudi oil would be priced and sold exclusively in dollars, with the enormous surplus revenues recycled back into United States Treasury securities, all of it underwritten by an American security guarantee. This single arrangement, more than any other, cemented the dollar's dominance for half a century. Because as long as the world's most essential commodity could only be purchased with dollars, every nation on Earth needed to hold dollars just to keep the lights on. Elena learns that this arrangement, while not dead, is fraying at every seam simultaneously. Russia has been settling its oil sales to China and the Chinese yuan for years now, a relationship that only deepened after Western sanctions cut Russia off from the dollar-based financial system entirely. Iran, under heavy sanctions of its own, moves crude oil to Chinese buyers through what amounts to a shadow fleet of tankers, with settlements happening entirely outside American banking channels. And by some estimates, well over 100 million barrels of Iranian oil have sat in floating storage near Chinese ports at various points, all of it destined to be paid for in yuan. Saudi Arabia itself has started experimenting, cautiously but unmistakably, with yuan-denominated payments for infrastructure projects. And Saudi officials have publicly signaled openness to pricing at least some oil outside the dollar for the first time in the arrangement's history. A cross-border payment platform involving the digital currencies of China, the United Arab Emirates, Saudi Arabia, Thailand, and Hong Kong has already processed tens of billions of dollars in transactions, with the digital yuan making up the overwhelming majority of that volume, all of it bypassing the traditional SWIFT messaging system that the United States and its allies have used for decades as a tool of financial leverage. None of this means oil stops being priced in dollars tomorrow. Most serious analysts describe it as erosion at the margins rather than collapse. 3 separate legs of the system, pricing, settlement, and reinvestment, each weakening at slightly different speeds, but all moving in the same direction. Elena closes her laptop that night, thinking about her fuel costs, her shipping contracts, her insurance premiums, and realizes for the first time that all of it sits somewhere downstream of decisions being negotiated in Riyadh, Beijing, and Moscow, far outside anything she can control or even fully see. The next piece of the puzzle that Elena uncovers involves the United States government's own borrowing. And this is where the story stops feeling abstract and starts feeling personal. She learns that the national debt of the United States has crossed $39 trillion, and that in the past year alone, all 3 major credit rating agencies, Standard & Poor's, Fitch, and finally Moody's, have downgraded the United States government's credit rating from its once pristine top-tier status, each one citing the same underlying disease, persistent deficits, rising interest costs, and a political system that seems structurally incapable of agreeing on a fix. Interest payments on the national debt are projected to exceed $1.8 trillion annually within the next decade, more than the government currently spends on defense, education, and transportation combined. Foreign investors still hold an enormous share of that debt, somewhere around $9.5 trillion worth of Treasury securities, but that foreign appetite is no longer limitless or guaranteed. Elena reads that debt auctions have occasionally drawn weaker than expected demand, that some of the largest historical foreign buyers have shown signs of pulling back or diversifying elsewhere, and that if foreign buyers ever decided to meaningfully reduce their holdings all at once, the United States Treasury would have no choice but to offer higher yields to attract other buyers, which sounds like a technical detail until you realize what it actually means in practice. Higher yields on government debt push up borrowing costs across the entire economy because Treasury yields function as the baseline interest rate against which nearly every other loan gets priced. Mortgages get more expensive, auto loans get more expensive, business loans get more expensive, credit card rates climb. Elena's own line of credit, the one she uses to finance inventory purchases months before her furniture actually arrives from overseas, is tied to exactly this kind of benchmark rate. And she has already watched her financing costs creep upward over the past year in ways that have nothing to do with anything she did wrong in her own business. She starts to see the whole picture connecting itself. Less foreign demand for dollars and dollar assets means higher borrowing costs for the American government, which means higher borrowing costs for American businesses and households, which means less investment, slower growth, and tighter margins everywhere, all flowing from a shift in trust that most people never notice because it happens in the language of basis points and reserve composition percentages rather than dramatic headlines. Then there is the currency's actual value, which Elena feels most directly of all. She reads that the broad dollar index has weakened noticeably over the recent past, with some forecasts calling for continued softening, driven by anticipated interest rate cuts from the Federal Reserve, as policymakers pivot from fighting inflation toward propping up a cooling labor market. A weaker dollar sounds abstract until you realize what it does to the price of everything that arrives in a shipping container. Elena's own imported furniture components, the steel hardware from Turkey, the upholstery fabric from various suppliers overseas, all become more expensive in dollar terms when the dollar buys less of another country's currency than it used to. Layer tariffs on top of that same weakening currency, and the effect compounds rather than offsets, because a falling dollar makes tariffed imports even more expensive than the tariff alone would suggest. Economic researchers have estimated that recent tariff regimes have already added over $1,000 a year in effective costs for a typical American household, with lower income households absorbing a disproportionate share of that burden because they spend a larger portion of their budgets on imported consumer goods in the first place. Elena raises her own prices to cover rising costs, the same way businesses across the country have been doing, and watches some of her longtime customers quietly reduce their order sizes in response because their own budgets are being squeezed by the exact same dynamic from a different angle. It becomes a slow, grinding cycle, rising costs met by rising prices, met by shrinking demand, repeating itself in countless businesses across the country in ways that rarely make a dramatic headline on any single day, but that add up over months into something that genuinely reshapes an economy. Elena starts to wonder if this has ever happened before to a dominant currency, and it turns out history has quite a lot to say on the subject, because the dollar itself became the world's reserve currency by watching exactly this process happen to someone else. Before the dollar, the British pound sterling reigned as the world's dominant reserve currency for roughly a century, backed by an empire that spanned every continent and a financial system centered in London that the entire world trusted implicitly. The pound's decline was not a single event either. It stretched across decades, accelerated by 2 world wars that left Britain deeply indebted, much of that debt owed directly to the United States. By the 1920s, the dollar had already begun overtaking the pound in global reserve holdings, and by the 1940s, the shift had become unmistakable, with the pound's share of global reserves falling from around 80% immediately after the Second World War to under 60% within just 5 years, while the dollar's share climbed past 85% by 1970. It took the better part of 2 full decades for the pound's fall from grace to fully complete itself. Notably, sterling did not vanish, and Britain did not become a poor or irrelevant country. It simply stopped being the default currency the entire world organized itself around, and Britain adapted, however painfully, into a smaller but still meaningful role in global finance. Elena finds this history strangely reassuring and unsettling at the same time. Reassuring because it shows that losing reserve currency status has never meant national collapse for the country that experiences it. Unsettling because it shows just how slowly and quietly these transitions actually unfold, invisible to most people, living through them in real time, visible only in hindsight to historians drawing charts decades later. She wonders whether people living in London in 1950 understood they were watching their currency's global dominance slip away in real time, or whether it simply felt to them like an ordinary difficult decade with rising prices and a government struggling to balance its books, no different in feel from what Elena is watching happen around her right now. Elena also starts paying attention to Japan, almost by accident, because a supplier mentions it in passing during a phone call about pricing. Japan has long been the single largest foreign holder of United States Treasury securities, holding well over $1 trillion worth at various points, a relationship built over decades of Japanese institutions parking their enormous trade surpluses in dollar assets. But Elena learns that Japan's own domestic bond yields have been climbing to levels not seen since the 1990s, as its central bank finally begins tightening policy after years of near zero rates, and that a weaker yen combined with rising oil costs from ongoing conflict in the Middle East has pushed the Japanese government toward more domestic spending, not less. Analysts warn that if Japanese institutions ever found it more attractive to bring capital home rather than keep recycling it into American debt, one of the steadiest pillars supporting the entire treasury market could weaken. And Elena begins to understand that the dollar's position does not just depend on what China or the Gulf states decide to do. It depends on decisions being made in Tokyo boardrooms too, and in Frankfurt, and in Ottawa, dozens of separate calculations happening simultaneously in dozens of separate capitals, each one small on its own, each one adding weight to the same side of the scale. She also looks seriously, for the first time, at the other candidates people mention as potential successors to the dollar, because it seems only fair to ask what exactly would replace it if the erosion keeps going. The euro is the most obvious name that comes up, and it does hold a meaningful and fairly stable second-place position in global reserves, somewhere around 20%. But Elena learns quickly why serious economists remain skeptical that it could ever fully step into the dollar's shoes. The eurozone is not one country with one treasury and one unified fiscal policy. It is 19 separate nations sharing a currency while keeping their own separate budgets, their own separate borrowing costs, and during moments of crisis, their own separate political incentives that do not always point in the same direction. A currency needs a single, deep, unified bond market behind it to function as the world's core reserve asset. And Europe, for all its economic size, has never quite solved that structural problem. The Chinese yuan comes up constantly in every article Elena reads, usually with more excitement than the data actually supports. Its share of global reserves sits at under 2% according to the most recent IMF figures, a number that has barely moved in years despite endless speculation about its rise. The reason is not mysterious once Elena reads enough about it. China maintains strict capital controls, meaning money cannot move freely in and out of the country the way it can with dollars, euros, or pounds, and its monetary policy decisions are made behind closed doors without anything resembling the transparency that global reserve managers require before they will trust a currency with billions of dollars of their nation's savings. Digital currency initiatives and new payment corridors help China's currency gain ground in specific bilateral trade relationships, but gaining ground in individual trade corridors is a very different thing from becoming a trusted global reserve asset that central banks everywhere are comfortable holding in bulk. That gap between growing usage and trade settlement and genuine reserve currency status is precisely where most of the current de-dollarization story actually lives, and understanding that distinction changes how Elena reads every subsequent headline. A country can reduce its use of dollars in a specific trading relationship with a specific partner, while the dollar's overall global reserve position erodes only gradually, because those are two different processes moving at two different speeds. The headlines tend to collapse them into one dramatic story, but the reality unfolding underneath them is messier and slower than any single headline can capture. Elena also starts watching the stock market with new eyes, noticing how periods of currency uncertainty seem to coincide with sharper swings in equity prices, as investors recalibrate what American assets are actually worth when the currency underlying them is behaving less predictably than it used to. She reads that gold's own price has swung wildly through the year, at one point posting its sharpest weekly loss in recent memory, even as the same survey data showed record central bank buying intentions, a contradiction that initially confuses her until she learns that short-term trading in gold futures and long-term strategic buying by sovereign institutions are essentially two different markets moving on two different timelines, one reacting to interest rate expectations and inflation data day to day, the other reflecting a multi-year strategic repositioning that barely notices weekly price swings at all. It is a useful lesson, she realizes, for how to read almost every piece of financial news that crosses her feed from this point forward, always asking whether a given data point reflects a short-term trading reaction or a longer structural shift, because conflating the two is exactly how so many people either panic over noise or dismiss signals that actually matter. Elena's business does not collapse. Nothing in her life collapses. That is perhaps the most important thing she comes to understand from all of this reading and worrying. The United States remains home to the deepest and most liquid capital markets on the planet, an ecosystem of technology companies that continue to attract talent and investment from every corner of the globe, research universities that remain the envy of nearly every other nation, and an entrepreneurial culture that keeps producing new industries even as older advantages erode. None of the alternatives circling the dollar right now are remotely ready to fully replace it. The euro carries the burden of a currency union split across nations with wildly different fiscal priorities and no single unified government standing behind it. The Chinese yuan remains hemmed in by capital controls and a lack of the kind of transparent, independent monetary policy that global investors require before they will trust a currency with their life savings. Gold and a scattered basket of alternatives can chip away at the edges of dollar dominance, but none of them offer the deep, liquid, instantly tradable markets that global commerce actually needs at the scale the modern world requires. What is happening is not a sudden dethroning. It is a slow, uneven redistribution of trust, playing out over years and likely decades, visible only in incremental data points, a percentage point lost here, a new payment corridor opened there, a credit downgrade here, a new central bank gold purchase announced there. Helena adapts the way businesses always eventually adapt to forces outside their control. She diversifies her supplier base, leaning more heavily on domestic manufacturers, even when their prices run slightly higher, simply because the predictability is worth something in a world that feels less predictable by the month. She renegotiates shipping contracts, builds in more buffer for currency swings, and starts paying closer attention to Federal Reserve policy announcements the way she used to pay attention only to shipping schedules. She realizes that the businesses and households that come through periods like this intact are rarely the ones with the most exposure to global finance. They are simply the ones willing to watch the shifts honestly, adjust early, and avoid the trap of assuming that because nothing changed yesterday, nothing will change tomorrow either. Elena starts having a version of this conversation with other small business owners in her area. At a Chamber of Commerce dinner, at her kids' soccer practice, in the group chat she shares with 3 other importers she met at a trade show years ago, and she notices the same pattern every time. Almost nobody has actually looked at the underlying data. Almost everybody has an opinion, usually a strong one, usually borrowed wholesale from whichever news source or podcast they happen to trust, and usually falling into one of 2 camps that both feel equally unsatisfying to Elena once she has actually done the reading herself. One camp insists the dollar is basically invincible. That talk of de-dollarization is recycled fear-mongering that has been wrong for 15 years running and will keep being wrong indefinitely, pointing to the dollar's continued dominance in global trade invoicing and the sheer absence of any credible replacement on the horizon. The other camp insists collapse is imminent, that the dollar's reserve status could evaporate within a matter of a few years, pointing to gold's surge past treasuries as the world's largest reserve asset, to the accelerating pace of BRICS payment infrastructure, to the credit downgrades piling up one after another. Elena has come to believe both camps are missing the same thing, which is that this is not a binary question with a single correct answer waiting to be revealed on some future date. It is a gradual repricing of trust happening simultaneously across dozens of separate relationships. Oil exporters recalculating who they trust to hold their surplus revenue. Central banks recalculating how much of their reserves they want, concentrated in one currency controlled by one foreign government. Foreign bond investors recalculating whether American fiscal policy still deserves the same premium it has commanded for decades. None of those recalculations happen instantly, none of them happen uniformly, and none of them are guaranteed to keep moving in the same direction forever either, because trust that eroded through one set of decisions can, in principle, be rebuilt through a different set of decisions, the same way it was built in the first place. What Elena has taken from all of this, in the end, is not a prediction about exactly when or whether the dollar loses its throne entirely, because she has come to suspect nobody, no matter how credentialed, actually knows that with any real precision. What she has taken instead is a habit, a discipline really, of watching the slow-moving indicators rather than only the loud ones, checking the IMF's quarterly reserve composition data the way she used to check only shipping schedules, paying attention to central bank gold purchases the way she used to pay attention only to fuel surcharges, understanding that a single credit downgrade or a single weak treasury auction rarely matters much in isolation, but that a pattern of them accumulating over successive quarters matters quite a lot. She has stopped waiting for a single dramatic headline to tell her the world has changed, because she now understands that the world rarely announces its biggest transitions with a headline at all. It tends to announce them in exactly the way it announced this one to her. A quiet percentage buried in a routine report, easy to scroll past, easy to ignore, and yet, if you actually stop and read it carefully, containing almost everything you need to know about where the next decade of global finance is actually headed. Looking back on everything she has learned, Elena comes to a conclusion that feels less dramatic than the headlines that first caught her attention, but somehow more useful. The dollar's exorbitant privilege was never some permanent law of physics. It was built over decades on trust, liquidity, rule of law, and the raw scale of the American economy, and it can be eroded the same way it was built, slowly, through accumulated decisions made by central banks, oil producers, and trading blocs that have concluded, rightly or wrongly, that spreading their risk across multiple currencies and assets serves them better than depending entirely on one. If the dollar continues losing ground as the world's primary reserve currency, the United States will very likely face a future of higher borrowing costs, more persistent inflationary pressure on imported goods, reduced geopolitical leverage through financial sanctions, and a more genuinely competitive global economic landscape than it has faced in 80 years. That is a real cost, and pretending otherwise would be dishonest. But it would not automatically mean economic collapse, mass poverty, or the end of American prosperity, because reserve currency status, as enormous a privilege as it has been, was always downstream of something more fundamental, the productivity, innovation, institutional trust, and adaptability of the underlying economy itself. Britain lost its currency's throne and remained a wealthy, influential nation. The dollar may be entering the early decades of a similar gradual transition, and what ultimately determines whether the United States thrives or struggles through it will not be the reserve currency status itself, but whether businesses like Elena's and the policymakers who set the rules they operate under choose to see the shift clearly and adapt to it deliberately, rather than discovering it too late, the way so many empires throughout history have discovered their own decline only in hindsight, reading about it in a paragraph buried in someone else's report.